This program on investing under regulation crowdfunding is not investment advice.
Rising with the crowd, power unbound, change makers lead where hope is found. Superpowers for good, shaping the fate. Investors and dreamers open the gate. Supercross stands loud, proud and true, building tomorrow for me and you.
Have you ever invested in an IPO and wondered if you were getting a fair deal? Well, or have you ever wished you could invest in an IPO and couldn't? Well, my guest today has written a new book about reframing the discussion about fixing capitalism fundamentally, with a centerpiece around raising early stage capital from the crowd using an IPO. Fascinating model, fascinating discussion. You don't want to miss this. But welcome to the Super Crowd Presents Superpowers for Good. I'm your host, Devin Thorpe, and our guest today is Karl Sjogren, the author of the Fairshare Model. So stick around. You don't want to miss this. Karl, welcome to the show.
Hey, Devin, it's an honor to be here.
Well, we're thrilled to have you, and thank you very much for uh, making the time for us. But let's start here with the fundamentals. What's the big idea that you have and explain in your book, The Fairshare Model?
Good question. Well, let me start off by showing you the cover. So it's called the Fairshare Model, and it's an idea for a performance-based capital structure for venture stage initial public offerings. I say it's reimagining capitalism at the DNA level. That's why it's got that imagery of DNA on the cover. Big ideas all have a premise. Mine is that no one knows how to value a startup reliably. And as I thought, the book's really written from the perspective of investors, IPO investors mostly, but also angel investors. And as I thought about this topic from an investor's perspective, startup valuation, I thought, gosh, there's a lot of risk factors for investors. But the more I thought about it, I thought you could really boil it down to two primary risks. One is failure risk, and the other one's valuation risk. Failure risk, I say, is things like, is this a good market to go after? Is this a capable management team? How long will it take to get a product? How much will it cost to get a product? Will customers like it? Will the business model scale? And I say venture capitalists are better than the average person at assessing failure risk because they're smart and they're very well networked. But I think it's reasonable to think that VCs are not that much better than baseball players at getting on base. The best batters get on 30 to 40% of the time. So I imagine VCs are better than the average person at assessing failure risk, but not that much better than baseball players at getting on base. They're super at valuation risk management. Valuation risk is the risk of overpaying for a position. And an investor can overpay for a position in a company that's managing failure risk quite well. The way they do this is deal terms. Deal terms have the capacity to expand the investor's ownership or basically reset their buy-in valuation if the company doesn't perform as well as anticipated. You can tell this is their superpower. Because if you consider the returns over the last 40 or 50 years by various asset classes, venture capital's done pretty well. Private equity's done well. They've done well in a space that has above average failure risk. So that indicates that managing valuation risk holds a lot of potential for reframing the relationship between entrepreneurs and investors. So the big idea in the Fairshare model is to adapt the VC model for private capital to the IPO market.
One of the great things that has happened in the last decade is an evolution around some of the rules for larger private offerings. The Reg A marketplace, the Reg A exemption from a conventional IPO registration created a path for becoming a public company. In other words, it sort of created a new, smaller IPO market. Is that a tool that you think fits in with your vision for raising venture capital in an IPO?
That's a great question. This vision of the fair share model actually is earlier. So the background story, one reason I call it the fair share model is that in 95, I started a company called Fairshare with another guy. I was CEO. And our vision was to, at that point, you only had Reg A, and Reg A you could raise up to $5 million under that exemption. But there were other offerings, in particular, an SB2 was called. You could raise up to 20. It was supposed to be the startup-friendly version, and you could raise up to 25 million. So our idea on Fairshare was to create a online group of investors who had potential interest in investing in one of these offerings. It could be a SB2, it could be a Reg A, it could be a score offering. And we wanted to kind of organize the buyers to get a better deal. So sort of a chicken and egg situation. We offered memberships, and the idea was that once we got to critical mass where we had enough members to potentially take down an offering, we would tell companies if they had a legal offering, if they passed a due diligence review, if they used our deal structure, the fair share model, and they allowed our members to invest as little as $100, we'd give them free access to pitch their deal. No commission, no fee, no nothing. So organizing the buyers to get a better deal. So the Jobs Act, with its reforming dramatically the Reg A offering from 5 million to now, as you mentioned, 75 million, expands the space. It's really a reflection of how the perception of raising venture capital in the public market has changed. When we started at Fairshare, I underestimated, frankly, how much the speed bumps that we'd run into with regulatory concerns. We were there combining in one sentence small companies, capital raising, and the internet. And some regulators, notably in California, but elsewhere, was saying, well, there's got to be something wrong with this. And now, you go again to where we are with the new Reg A Plus. It's a very different climate. Startups are considered cooler than they were in the mid-90s. More people know the word valuation. Gosh, you think about the SPACs, Special Purpose Acquisition Corporation activity that was going on over the last 2 or 3 years, and how people were bidding up the price of these companies that were having offerings that by law couldn't have any idea how they were going to use the money they raised, what kind of business they were going to enter into. That shows there's a high public appetite or interest in engaging in venture capital. So the fair share model kind of fits into that as a way to, it doesn't reduce the failure risk for investors when they invest in a small company, but it dramatically can reduce valuation risk.
Yeah, it's a fascinating idea. One of the concepts in your book that intrigues me is the idea of somewhat elevating and somewhat changing the way employees and founders are motivated by giving them a class of stock that is not tradable and under certain circumstances, but that would utilize that, I think, rather than stock options or other incentives. Uh, is that, am I understanding the model correctly? And how
Yeah,
does that fit in?
yeah. Let me describe it. So it's for a public offering. Uh, the requirement of the offering is that there's a tradable stock that emerges from it. So if so, Reg D private offering, maybe there's a way conceptually to make it work, but the Fairshare model is really for like a Reg A plus type offering. Could be an S1 too. Um, Two classes of stock, both vote. They share voting power. One's tradable, one is not. Tradable stock goes to investors, IPO investors, pre-IPO investors. It also goes to employees for value created as of the IPO. For future performance, where the preponderance of economic value is, which is hard to value reliably, the employees get a non-tradable stock. I call it performance stock, but it's a preferred stock. It converts into the tradable common stock, which I call investor stock, based on milestones that the company defines and describes in its offering document. Those performance measures can be whatever they want. I mean, if investors buy into it, it's good. There's going to be variation based on the industry, based on the stage of development, frankly, based on the personalities involved. But in the book, I suggest 5 broad overlapping categories that could be used. My favorite one is a rise in the market price of a stock. Okay? That's an indication that the employees are adding value. Second one might be developmental goals that are relevant, like release of a product, or let's say you're in biotech, progress getting through FDA testing. Third category would be operational measures like sales and profits. Fourth one would be the acquisition price, if there is one, because it's clear at that point how much value the employees created with their labor using the investor's capital, and it's time to divvy it up. The last category I think will be particularly intriguing for your audience. It can include measures of social good. There are a lot of investors interested in investing in companies that are trying to do something good for the planet or particular communities. Things that have social value, but the economic value may be ambiguous. So let's say you're a company that's intercepting plastics from the waste stream and doing something to it so that it's not ending up in a dump. So that's something that has high social value. A lot of people would want to support that, but the economics of it may not be really well defined or overly attractive, but it has high social value. That type of company might say, hey, for X number of tons of plastic that we reprocess, Y amount of performance stock converts. So it's very flexible. You know, in at least in men's clothing, there's this term bespoke. Clothing that's sort of tailored in fabric and cut and all of that to the individual. The Fairshare model is a bespoke capital structure. So entrepreneurs can figure out how to make it work with their target audience.
That's great. Well, Karl, I really appreciate you taking the time to share this information with us. This is exciting, but we've got to take a quick break here now. Super Crowd, I'm here with Karl Sjogren. He is the author of the Fairshare Model. It's a conceptual framework for sort of reinventing capitalism, especially the capital markets as we know them. And it really is an exciting idea that is worthy of additional consideration. I encourage you to get the book and to check it out. But we're going to take a quick break. When we come back, we'll talk to Karl about his superpower. You don't want to miss this.
Download a free copy of How to Make Money with Impact Crowdfunding, the book Sarah Hanks describes as
a fantastic overview, not just of crowdfunding investing, but of investing in general.
Andrew Savickas raved,
"This book offers unparalleled insights for anyone looking to make a difference."
Scan the QR code to get your copy. Supercrowd 25, where innovation meets impact.
18 hours of live content, 5 platforms, 1 global audience.
Join the largest event for regulated investment crowdfunding. Live pitches, expert panels, real change.
August 21st and 22nd.
Scan the code or visit thesupercrowd25.com to register free today.
Struggling to raise capital for your business? Unlock the power of the crowd with AI. My free guide, Crowdfunding Made Simple, walks you through every step to success. Get funded smarter, faster. Scan the QR code now for your free download. Welcome back, everyone. I'm so excited to share with you today this discussion with Karl Sjogren, the author of the Fairshare Model. He's a great human being and a successful business leader in the California's Bay Area. This is an important discussion. We're going to shift gears now to talk to Karl about his superpower, so stick around. Karl, you have accomplished a lot in your career and developed a reputation as a real thought leader in this community. What is your superpower?
I think I discovered it when I was in Fairshare, doing Fairshare, trying to create that membership before we had offerings to offer. Part of it was, I was doing analytical stuff and writing up stuff. But the thing that I remember, we had a woman who would be proofing what was going up on the web that I wrote beforehand. And she said, "This sounds kind of important, but it's sort of boring." That was sort of a wake-up call, which was how to make something complex accessible and interesting to people who don't know about it, may not be particularly interested in it. That knock on the side of the head, if you will, caused me to think differently about how I go about expressing insight that I come up with on capital markets. And I think it's kind of cool. Just even like the DNA cover. I'm really facile with analogies. So I'd say my superpower is the ability to look at something that's complex somewhat differently than other people would, and to break it down in a way that is accessible to others. And that's what people will find in the book. It's I'd say it's broad and shallow. It covers a lot, from philosophy to economics and failure and all sorts of things, but it's not too technical.
Yeah, that's great. So, Karl, can you think of an example of how you've used this superpower of simplifying and sharing and clarifying complex ideas? And think about a time when you used that superpower to good effect, where you had a good outcome, a specific example of using that. Can you think of a time you could share with us?
Gosh, it's used when I'm working as a CFO with startups. I use it oftentimes to try to figure out where we need to go and who our audience is, what our priority is. The book's full of them. I'll give you one example that's in the book to deal with this capital structure idea. So in it, imagine that we have one of these balloons, like a tube balloon that you could tie and make dog shapes or whatever. but instead of air, it's full of uncertainty. So you can squeeze the balloon and you can move the uncertainty around, but you can't get rid of it. Okay? Now imagine that one side of the balloon is ownership interest. Who has what? The other end is performance. The performance going to be there. So in a conventional, and then I say, imagine that we have a weight which represents uncertainty. Certainty. So if you put, it's conventional to put certainty on the ownership side of the balloon. So this is what everybody is going to, they're pieces of the pie. And the uncertainty moves into the other side, the performance side, and say, hey, is the performance going to be there? What is it going to be worth? Okay? That's what a conventional capital structure does. It creates certainty on ownership and uncertainty on performance. The Fairshare model, the weight comes down on the performance side. The performance is delivered. It's clear it's there. Now the question is, how is that going to be distributed between founders and other employees? This is something that the companies themselves decide how to do, but that's that dynamic. Now, interestingly, when I thought of that analogy, I realized that the VC model has two weights, and it's suspended above the balloon. In other words, with the deal terms, until there's certainty on performance, there's uncertainty on the ownership side.
Yeah. It's a fascinating explanation, but it's a nice demonstration of your superpower. Now, I wonder, Karl, if you could give us some tips to help us do that better ourselves.
To explain things more simply?
Yes.
This is okay. So think about, try to be as specific as you can about what you're trying to do. I think a lot of people sometimes are, especially if it's trying to change the world, if you will, they're kind of focused on the atmospherics. They should be thinking a bit about on a grounded level what they're trying to accomplish. Think about why it should be important to the different constituents that are going to be involved in this particular process. Don't use too many words. Try to, when you're writing, every word should have a purpose if you can. And try to consider the objections, address objections that people may have or concerns. You just don't want to be breathing your own exhaust because audiences aren't going to be doing that. I think those are the basic ideas. Try to find ways to broadly but simply define a problem and how you're going about trying to solve it.
That's fantastic. Now, Karl, tell us a little bit about the best way to get your book. And I know a lot of people are going to want to talk to you. They're going to want to connect with you. So also share the best way to do that. Is there a way to follow you on social media or schedule an appointment? What do you think?
So yeah, LinkedIn. I'm pretty active there. By the way, the book when it came out, I wrote it from the perspective of investors, but I realized I had to pivot because people don't necessarily get books anymore, or if we do, we don't necessarily read them. We all have books on the side of our bed table. So I'm going through a series of articles that I'm posting on LinkedIn, also on Medium perhaps, and Substack, that are going to go through and describe how to implement a Fairshare Model IPO. I've got maybe 3 or 4 articles up there now. I'm working on one that will go up shortly that will describe how to set a pre-money valuation. I'm particularly interested in engaging with entrepreneurs and angel investors who are interested in seeing if this model could be applied to them. I am working with a company in the Bay Area that plans to be the first one to have a Fairshare Model IPO, perhaps later this year or very early next year. It's a startup that's in the modular housing space, makes modular housing out of shipping containers. Okay?
Wow. Wow,
Yeah.
that's exciting.
So,
Well,
so
Karl,
I'm looking for
thank you.
companies to try it.
Yeah, thank you, Karl. I appreciate you taking the time to be with us. We want to wish you every success in advancing this profound discussion around how to fix capitalism to make it even better.
Oh, and by the way, the book's on Amazon.
All righty. All righty. Thanks for joining us.
All right, thanks.